Marilla Fernandez. Thanks for joining us on Market Call. Eric Nuttall on the show today, partner and senior portfolio manager at Ninepoint Partners. He's taking your questions on energy stocks. Call us toll free, 1-855-326-6266 if you have a question for him. You can also send us an email to marketcall@bnnbloomberg.ca. Eric, thanks for coming in. The price of oil has been bounced around a lot lately. How much of it, or is all of it, a reflection of what's going on with tariffs?
I think it's the market is really trying to get its head around two massive uncertainties. One is tariffs, the impact that may or may not have on global GDP and by extension on global oil demand. We've had a few different people cut their estimates. So Goldman Sachs cut demand to only 400,000 this year. The IEA overnight or this morning cut it to about 750,000, 800,000. And even Energy Aspects, who is a consultant we use, they've been known to be more bullish on oil, cut their demand growth this year to about 800,000. So that's a key unknown. And there's some parallels being drawn to March 2020 and today, because then we had a demand shock. Now we have a potential demand shock. And at the same time, in both time periods, we have uncertain OPEC plus strategies that they're employing. Back in March 2020, during COVID, with the height of the impact to demand, Saudi Arabia surged their production to their maximum sustaining capacity of about 12.5 million barrels per day. Today, what we have is the voluntary members of an OPEC deal that has curtailed volumes announced that not only are they going ahead with their plan to add back barrels, but they're in fact accelerating it in May by a factor of 3 or 3 times faster than what they had said. And so the market is thinking, okay, is this a battle for market share? Is this some, behind the scenes deal with the United States, et cetera? Our read on the situation is, in fact, what it is intended to do, as they wanted to in March in 2020, is take action to force action on the part of some members of a deal, or within OPEC then. Today, we have chronic cheaters of the deal, mainly Kazakhstan and Iraq. They're cheating by about 500,000 barrels per day. And meanwhile, countries like Saudi, which has been adhering to the deal, well, they're suffering from that. And so I think it's intended to force greater compliance. We've yet to really see it show up. So it does make me a little nervous for the next meeting. Like, will they announce
I was going to say, do you think it'll work? Will that strategy by Saudi Arabia work?
We're not seeing it yet. Yeah. So we use a firm called OilX for data. So they do monthly estimates. So in April, what we're seeing is production's down a little. But, okay, they're only cheating by like 350,000 barrels per day. So we're not yet seeing the compliance. So that it does raise some concern about what OPEC and certain leadership within OPEC is going to be doing in the next several months. So the market's battling with these massive uncertainties. Oil, it's interesting. So our belief was, how do you find a floor in oil? We just have to wash everybody out. And what we saw last week is every Friday we get a report on how much net speculative length has changed. Well, last week there was so much financial liquidation in the paper market for oil that 1 week drop was the sharpest as far back as our data goes, which is 2011. And so the market's very, very short or unexposed to oil. So all of the financial players have just been washed out. Nobody's bullish. Everybody's throwing in the towel. So it feels from a sentiment perspective, we reached the bottom. I do struggle a little with, okay, what's it going to take to, see $75 or $80 over the next year, because we've got massive demand uncertainties. I admit that could change with a single tweet. So I caution people, you can't be too bearish, because things could literally change like that.
In an instant.
But from a supply perspective, we're killing U.S. shale. We're in the death zone for short cycle supply growth. We think it's $60, call it where we trade today. Shale will be down by 500,000 barrels per day. So that's reflective of about a 0.5% drop in global GDP, pretty draconian.
Yeah.
Long cycle, it's going to take time. OPEC seems to be signaling that they want to continue returning barrels onto a market when you've got demand challenges. So it does feel like the market could be sloppy for the next year. So
got it.
From a fund perspective, we've been heavy natural gas. We've been increasing our natural gas. We can talk about that later on in the program.
I was going to say, let's hold on to that, because I do want to talk about natural gas and whether we've seen any fluctuations there as a result. But let's take a quick break. Eric Nuttall, the senior portfolio manager at Ninepoint Partners, taking your questions today on energy stocks. Here's how to reach us. We're back in a moment with some of your phone calls. Welcome back. Let's go right to your email question. Steve has a question for us today saying Cenovus Energy is down significantly. Should I hold or sell and buy a better oil and gas stock? Again, Cenovus.
Yeah, so clearly Cenovus gives you very high price exposure to the oil price and secondarily to the differential for Canadian heavy, which is actually back to almost new lows. So there was an announcement the main line is flowing again. So we've seen differentials narrow. The big catalyst with Cenovus is it's not so much their upstream, so their oil and gas production. They remain super high quality assets, runtime, everything is going exceedingly well. It's always been about their downstream for the past 2 years. They've had very poor utilization rates. They've had mishaps. They've had negative EBITDA. So the market is really watching to see, okay, when can Cenovus right the ship on downstream? Because it has massively lagged its peers for that reason. You can make the argument today you're paying zero for the downstream operations right now. Because when I look at it, I'll reference 60, it's trading at 4.5 times cash flow, an 8% free cash flow yield. Their peers are trading 6 to 8, so a big discount. I would actually speculate potentially that if I was another large Canadian company, if I were looking at taking advantage of negative sentiment, weak pricing, I would actually be looking at Cenovus. I think their strategic merits to a name like a Suncor is vastly improving by the day. And I would say we're at the point of maximum pessimism from a stock perspective. We don't own it, and we're watching it closely, as I'm told many other accounts are, because this is a name that you could get meaningful re-rate potential if they demonstrate better downstream reliability.
So because he already holds it, you're saying you would look at it where it is now. Because he already holds it, should he hold on to it at this point?
Yeah, this is a good time to contemplate when we've had a significant market sell-off. If you can do a tax loss, crystallize a loss, and cycle that money into a like name, like beta, like upside, like valuation, maybe like similar dividend yield, that makes a lot of sense. I would be hesitant right now with Cenovus because I had a good meeting with the CEO last week. They really feel like they've made the personnel changes they need to. It's going to take time. This is a second half 2025 to early 2026 story. But the value proposition in this name is you could wake up to, I'm going to say a 50% premium to the current price, and it would still make financial sense for an acquirer like a Suncor. So I'd be hesitant at selling it now. There are other names that if I was asked about, it's okay, take the loss, move it into XYZ. On this one right now, it's near the top of our list, even though our incremental dollar we want to deploy into natural gas, not oil, it's near the top of the list.
Okay, let's go to the phone lines. David's on the line calling from Ottawa today with his question. Hi, David.
Oh, hi. Thank you for taking my call.
David?
And my question is on CNQ. Actually, for the past year in 2024, CNQ has not done well at all. And now, recently, oil prices have come down over $10. Are you still holding CNQ, and do you believe that this is a good stock to have during this turmoil? And do you own CNQ? And thank you very much. Have a great day.
Let me ask you, first of all, we see the big dip, of course, that has started this year, but it's been going down all year to date.
It has.
And that's last year as well. What is happening there?
I would say that over the past 6 months, CNQ and MEG were the two poster children for Sell Canada, Sell Energy, and sell names most exposed to the WCS differential, because there was a worry at the time, and I've been on this program a lot, in fact, I'm on Twitter, saying we do not think the United States will apply tariffs on Canadian oil. But if we were wrong and they actually did, it likely would have resulted in a blowout in the differential to about $17. We're right around $9 now. And if you don't have downstream those refineries to buffer that, you would have to eat some portion of that. And so I think CNQ has been heavily for sale. How I manage the fund is different than how somebody likely manages their personal account. I have to be a little more sensitive to shorter term gyrations. And so we've sold our CNQ, we harvested a decent tax loss for our unit holders, and it's our intent to deploy more into natural gas. It's more of a short to medium term phenomena. CNQ, though, is a name, the guy owned it personally, you stick it away. This is a name just to sit on. You've got one of the deepest resource bases. I continue to be bullish on oil, not now, but I'm talking, let's say 6 months, 9 months, a year from now, we'd have to get past the economic headwinds, the tariff headwinds, absorb some OPEC spare capacity. I'm still a believer in meaningfully above $80, but that's not a today call. And so if you're looking for, again, this is an example where if you really do want to crystallize a tax loss, you could sell it, recycle into another name, maybe a Cenovus. You get a little more oil than natural gas. Or if you take a longer term perspective, you get one of the deepest resource bases of any large company on the planet from an oil and gas perspective. You have a management team that is rock solid, and you're getting paid now a 6.1% dividend, which is extremely sustainable. So it's defensive. It hasn't been acting like that. I think it's the sell Canada, sell what if Carney gets in. It's more 4 more years of the past 10, which haven't been splendid for the oil and gas sector. There's a lot of reasons why I think people have been selling Canada and specifically this name.
Got it. Let's go back to the phone lines. Joe's on the line from Montreal with a question. Hi, Joe.
Hi. I want to ask Eric about Whitecap Resources. I'm retired. I sold it back in December, a little bit over $10, and I was thinking of coming back in, but I'm really concerned about, if Russia starts putting more oil in, Arabs are putting more oil, producing more oil. What is the safety factor for this, for a income more and also a little bit of growth with this kind of a market? Thank you.
Okay, so we bought it at 10. It's now at 7.88.
So from a dividend perspective, we've got sustainability around $55. So the sector average is 51. This is 55. So right now you've got about $6 of margin. With that said, this company is growing about 3 to 5% per year. I met with probably 10 different companies last week, and the common theme is business models in general are extremely strong. Companies have been paying down debt for the past 2-3 years. The balance sheet's very, very strong. It's $60 oil. Average debt to cash flow is less than 1 times. Secondly, dividends are sustainable down to about 51. Thirdly, in this environment, it makes little sense for anybody to actually be organically growing through the drill bit. And so I wouldn't be surprised if we're staying at 60 to see a name like a Whitecap dial down their growth capex, which makes that dividend even more sustainable. And so with a yield of 9.3%, the stock did get sold off on the day that it announced that it was acquiring Veren, which was a name we were Veren's, I think, second largest shareholder on the day of that. We continue to hold Veren/Whitecap as the same thing in the fund. I would view it as a vehicle. It's been a little diluted, but you've got very good Montney exposure where the quality of their assets we think is significantly better than the market is appreciating. You get a 9.2% dividend. I said, sustainable down to 55. It's likely about 52 if you dial down growth capex. You've got underlying asset base, which is not appreciated. It is more of a mid-cap, market cap just under $10 billion pro forma. So it's not a name that is in favor. But would you want to sell something yielding sustainably 9.3% that is sold off? You get good natural gas weight, you get good Montney weight. This is not a name that I'd be selling right now.
Got it. All right, we do have to take a quick break. Eric's sticking around to take your questions. We're back in a moment. Welcome back to Market Call. Thanks again for joining us. Going right to your phone calls. JC is on the line today from North Bay, Ontario. Hi, JC.
Hi, can I ask about Meg Energy? I've held it back since the takeover days with Husky and everything. Got a good gain, a little position left. Should I sell it or should I add? What do you think?
You bet. So I met with the CEO, Darlene, last week. She has some swagger in her step. It is a very defendable business in the current oil price environment. What I like about Meg is you get just massive resource depth. I believe that U.S. shale is in its twilight. What we're meaning is companies suffer from a profound inventory challenge, and they will eventually have to come to Canada because we're the last remaining investable basin with natural resources of incredible depth. And so there will be a scarcity premium placed on companies like a MEG. In the current environment at 60, we have it trading at about an 8% free cash flow yield, so very, very healthy, even at 60. Over the next 5 years, we'd have them being able to buy back about 30% of their shares. That's at 60. If you even just want to dare to dream in a 70, where we were not that long ago, that number doubles. They could buy back 60% of their stock. And so it's a very clean story. You've got at least 35 years of stay flat inventory. You've got a single asset that is of superbly high quality. You have a balance sheet that has been healed over the past couple of years, and so they're very, very sustainable. And what they intend to do is modest organic growth and use all residual free cash flow to buy back their stock. It's been sold off again on tariff concerns. It hasn't been able to recover from that. It remains about a 10.5% weight in the fund. I can't buy anymore because I'm capped at 10. It remains a name where we have a lot of confidence in the medium and long-term outlook for it.
So hold and dip in if you can.
I would.
Got it. Let's go back to the phone lines. And Daniel's on the line from Markham, Ontario. Daniel, what is your question today?
Hi, Morella. Hi, Eric.
Hi.
May I have your thoughts on Imperial Oil? Compared to CNQ, which of these companies executes the Eric Nuttall playbook the best? As usual, Marilla Greathouse and Eric, one of Mark Cole's best guests. Thank you.
They're both superb. You know, Imperial has been a very aggressive buyer of their stock over the past couple of years. It's performed very, very well. On our math, it trades at a premium, which is deservedly, but I would prefer a CNQ today. So if you own Imperial and you're sitting on a loss, to me, this is a very good tax switch. A lot of the upside is based upon an SIB later in the year, significant issuer bid. That's a little more vulnerable with the pullback in the oil price. They've got a very strong balance sheet, but free cash flow isn't today what it was all that long ago. So if you're sitting on a loss, this is a good candidate. I'd be contemplating doing this for everybody in the energy sector today is sell it, take a loss, tax benefit down the road, cycle it into a CNQ, which is meaningfully underperformed, where you still get a really, really good management team and a superb suite of assets.
Got it. Let's go back to the phone lines then. Brian's on the line from Victoria, BC. Hi, Brian.
Good morning. Good morning, Eric. I wish you were on every week.
Oh, thank you.
But, it's tough to talk to you when I can. I'd like your prognosis for Tourmaline Oil, TOU. Thank you very much.
Yeah, so Tourmaline, unfortunately, overnight had an incident at one of their gas plants resulted in a fatality. I don't think it's been widely reported yet. Our belief is it's going to have only a short-term impact on production. It's about a 400 million cubic feet per day plant. So it has been a little weak today, I think, as that news is being digested by the market that just broke overnight. Really, for Tourmaline Oil, despite the name, it's a natural gas company. They, within Canada, would trade at the highest premium relative to its peers. That'd be at a $60 to $65 WTI and about a $4 NYMEX. Our preference is for other names today. We would have meaningfully larger weights in names like an Expand, like an EQT in the United States, an ARC, a Nuvista in Canada. But there are fewer names to invest in when it comes to natural gas. And so the debate is it worthy of the premium? What's the scarcity premium going to be for this type of name? You can't, there are no chinks in the armor when it comes to the management and the resource depth. Some people, including myself, have commented that perhaps they shouldn't be organically growing as much as they have ahead of LNG Canada. But in a world where I think we're in a multi-year bull market for natural gas, we think the marginal supply cost is $5 NYMEX. At a time when LNG Canada is starting to ramp up, and the discount should fall from $2 to about $1.10 for AECO, it's a very bullish backdrop for Canadian natural gas producers.
Okay, let's go back to the phone lines now. We've got Bernie on the line from Belleville, Ontario. Bernie, what's your question today for Eric?
Yes, Eric. Thanks for taking my call.
You bet.
I'm looking at Parex Resources. I'm underwater on it, but it's got a pretty good dividend. I was just wondering what your opinion is on it and how sustainable that dividend is.
It's not. We would peg the dividend sustainable at about $63 oil, so a little above where we are today. Yes, it trades at a 13% yield. If you have some potential gains later down the road, this is a great candidate, I think, to sell. Take your loss, and I would buy another high-yielding name. Somebody asked about Whitecap earlier in the name. It's a name I own personally as well. You get a dividend that is much more sustainable, maybe not your 13%, but just a clip over 9%. I think the quality of the assets is meaningfully better. You don't have to take on Colombian geopolitical risk, and it's a management team that I would have more confidence in. So,
can you tell me a little bit more about Parex? Yeah,
so this is a Colombian name. It was in favor years ago. They had a CEO change. What they really did was they overcapitalized one area where they got a positive well result on an exploration well. They spent about $250 million. They then realized that they had downhole issues with asphaltene, as just means the wells basically died much faster than they thought. And so they incinerated $250 million. And it's always been a shorter reserve life index company. So they're always relying on exploration. So when you have such a phase plant, it meaningfully impacts people's confidence in the go-forward viability of the model. And it's the reason why I love Canada so much. You can buy into the Montney, the Duvernay, the oil sands, and you get decades worth of stay-flat inventory that doesn't erode in quality over time. Or you can go to a high decline rate where you've got geopolitical risk challenges, where the government's been talking on and off about windfall taxes for the past couple of years. Admittedly, we did too up here, but you get the gist. Like, it's not worth the risk today. I just think there are better opportunities.
Got it. Okay, we do have to take a quick break, but when we come back, we'll have a look at past picks. We're back in a moment. back. Time now for past picks. Eric is at the desk to walk us through what happened, first of all, with Varen, which was your pick, Eric, back in April of 2024, April 2nd to be exact, of course. It was bought by Whitecap. Formerly it was Crescent Point Energy. At the time, it was $11.52, now down to $8.09, so a 30% drop in returns, total return 26% drop. Was it the buying by Whitecap? Was it also the oil prices? What's happening here with Varen?
The biggest driver of Varen last year was they used a new completion technique on their wells, just how they were fracking them. It was initially successful. They went on to deploy that at 12 or 14 more wells, fast track a month. It was proved kind of like Parex we referenced earlier. They realized, okay, we got some bad, false initial data. So it made the market skeptical about the quality of their assets in the Montney because they've been very active acquirers over the past couple of years from Shell and other companies. They had assembled a very enviable position. But suddenly in a risk-off market, the bad results made people condemn the value of the play and the stock sold off dramatically. We aggressively added to the position late last year. My partner, Keegan, is a geologist, spent a lot of time with their team to walk through, and we had a high degree of confidence that if they just went back to how they were fracking the wells before, they'd get the results they were getting before, and suddenly the market's perception of the value of their acreage would improve. We were weeks away from that happening, and then I woke up on a Monday morning to a press release that they were getting taken out at a 39% premium by Whitecap. So I think Whitecap saw what we saw. Their timing was not, coincidental. Craig Briscoe, we have a lot of liking for, is a very honorable man. He'll be now on the board. So when I talk to Varen, it's really Whitecap. Whitecap pro forma, you're getting a larger entity. It can compete with the likes of ARC, trading at a 5.5 times multiple at $60, $4 gas. That falls to 4.2. So call it 4.2 pro forma next year, a 7% free cash flow yield, and a 9.2% dividend yield, which is sustainable at anywhere from between 50 and 55. We think they've been doing Whitecap was having some great Montney results, which were underappreciated. Combine that with Varen's very successful Montney results, we think that they've got the potential to get a meaningful re-rate over time when the market digests it and when we're in a more of a risk-on market. So in the meantime, you get paid 9%. To me, that's moderately compelling, and you're getting a stock trading at deep value with balance sheet management, resource depth, all of the boxes that we need to check off.
Got it. Okay, let's get to your pick from last year of Baytex Energy. At the time, it was $5.30. It's now down to $2.26. So a 57% return drop and total return of 56% drop. What's happening with Baytex since last year?
So 100% of the move is related to the oil price sell-off, a name that has more debt than the average in a risk-off oil price environment that we find ourselves in. Management team has actually done exactly what they said that they would do in terms of well results in the Eagle Ford and such. They've had some good conventional heavy oil results. But this is a name where at $60 oil, the debt's too high for most. From a liquidity perspective, they're totally fine. Like it's either they have long-term bonds or they have bank lines that were not subject for renewal for several years' time. So they're totally fine from a liquidity solvency perspective. This isn't like March, April 2020 when I was tweeting, this company XYZ is like 3 weeks of liquidity, these guys are 6. Like it's a very different environment. I joked with the partner, I was like, if this ever gets a one handle, we're going to buy it back because we sold it close to $4 for the fund. Sure enough, it hit $1.91. I was in meetings, I didn't get around to it, and then it rallied 25% in a single day. So this is a name where I recognize there's very deep value. This really needs 65, really 70 to really start humming. They're sustainable at about today's price in terms of maintenance, CapEx, and sustaining a very modest, or not modest anymore, 4% dividend. It used to be 2%. I continue to like the management team. It's just this is a stock that's not going to work at $60 oil.
Got it. Okay, let's get to your last past pick, which was Precision Drilling from April last year. 96.01 recommended, now down to 57.98, or a drop in return 40 and total return 40% as well. Again, how much of this is the climate we're in currently?
So we would have sold this position, I think, around $90 for the fund, give or take. Clearly, with $60 oil and a natural gas strip that isn't high enough to incentivize meaningful drilling, the service sector has been completely eviscerated. Precision is that they've got high quality rigs, they've got exposure to some good basins, modest share buybacks, not as much as I would have liked back when they had meaningful free cash flow. On paper, it still screens really well. I will say I don't have tremendous confidence in our own estimates because it's a very dynamic situation. I do think that if you're a U.S. shale producer today, any unhedged barrel, you're not completing wells or you're not drilling them. Any capex that can be cut, you're cutting in real time right now because you're just not motivated. We think you need at least 65 to justify drilling. We're at 60 now, strips falling off below that. So the backdrop for the service sector is pretty poor. Is the stock reflecting long-term potential? And if we get $5 gas and $70 oil in a year's time, it's a much better backdrop. But between now and then, there's a lot of wood to chop. And if the market continues to be risk off, this is not a name that we think is going to do very well. So I can say, sure, it's trading sub 3 times, a 33% free cash flow yield, balance sheet's fine, they've paid down debt. But in all honesty, this is not in the near term. Not in the near term. This is going to be stock.
All right. Eric Nuttall sticking around, Senior Portfolio Manager, Ninepoint Partners. Taking your questions on energy stocks. We're back in just a moment. Welcome back. Let's get to your phone calls. Elliot is on the line today from Hamilton in Ontario. Hi, Elliot.
Good afternoon. Please, your thoughts on Freehold and its dividends.
You bet.
And I've lost track. Where are we on the Mackenzie Valley pipeline?
I've lost track of that one, too. Freehold, this is a very boring name that pays you a 9.5% dividend yield that by our math is sustainable down to about $46 WTI. That's using $4 gas. So this is not on anyone's radar screen. Institutionally wise, it's just too boring. Everybody would rather buy a Prairie Sky. This trades at half the multiple. Asset quality isn't as good, but at a 9.5% dividend yield, if you want what we think, like unless we're going to repeat COVID, and even then we averaged $40 oil, this is sustainable, we think, down to about 46. So this isn't a get rich overnight, very boring, very, you're not taking on exploration risk. It's a royalty stream. But for 9.5% yield, we like it a lot. We own it in the income fund. I own it personally.
Okay, so there's a good one if you don't mind being boring. Okay, we'll go back to the phone lines. John's on the line from London, Ontario. Hi, John.
Hi, Marilla. Hello, Eric. I'm sifting through the ashes, Eric, of my once prolific portfolio in the energy sector.
I feel it.
I'm a buy and hold investor. One of the stocks that had done the best, CES Energy Services. It had done so well, pays a good dividend. Dividend's even higher now. Is this one I can hold, or do you insist that I dispense of it? Thank you.
Yeah, we've owned it in the past too. We sold it higher earlier this year, probably around $9 would be my guess. I am tempted as well. There are a lot of temptations out there right now, whether it's a Cenovus, whether it's a CEU. There's a lot of names that we think are trading well below what intrinsic value is. It's difficult to see a near-term catalyst, but if you are truly buy and hold, which very few people say they are, but when it's time to buy and there's panic in the streets, very few people do, even though that's when you can make your fortune. We look at this name, extremely strong balance sheet, very competent management team. They are a niche player. Their biggest competitor is being acquired still by Schlumberger, which is typically not known to be very good at what CES does, so they're gaining market share. They have an offshore opportunity, which is not something they've ever had access to in the past, which they've talked to. Is the spending environment today wonderful for a service company at large? Not very much. So the stock, I think, is going to struggle unless we get a tweet that improves people's view of the global GDP. Oil could rally by $5, and this is a name that you could rally by 15 to 20% on that. Barring that, our preference is to either buy a more pure play oil name yielding 9 to 10%, or buy natural gas.
Got it. Okay, let's go back to the phone lines and get in one more caller before the break. Ron on the line from Markham, Ontario. Hi, Ron.
Hey, hi. I'd like to get the King's opinion on Pinecliff. I've been holding it for quite a while, and I was wondering if buy, sell, or hold.
Yeah, so Pinecliff, there's nothing wrong necessarily with the asset suites or management or whatnot. It's just the market cap. And this is not a tape where it's going to be conducive to meaningful outperformance on small caps. The small cap model in Canada is effectively dead. It's obsolete. You can't afford to drill the vast majority of wells that are being drilled today when they cost $10 million when, maybe that's going to be 10% of your market cap. So this is a name where, even though the assets and everything else might be fine, just from a stock market perspective, it's exceedingly challenged. So if you're sitting on a loss, and this is nothing against Phil or anything, but I would probably contemplate taking the loss, and I'll have 2 other suggestions later on in the show for you.
Got it. Okay, we are going to take a quick break, so stick around for those suggestions as well as taking more of your phone calls. We're back in a moment. Welcome back. Thanks for joining us today on Market Call. We want to get to your phone calls right now. Gordon, been holding on the line from Victoria, BC. Hi, Gordon.
Hi. Headwater is a good operator. With all the bargains out there right now, I see domestic aggregation occurring in the next year. And then with the Americans, with their high dollar, I see them coming in and buying the aggregated reserves to offset their peaking shale production issues. Your thoughts on that? And the one thing that scares me is keep it in the ground, Carney. What happens to our number one export industry if he's elected?
Yeah. I'll just touch on Headwater. I'll get myself into trouble if I delve into politics. We're going to have a decision whether we want to change or if we want more of the same of the past 10 years. When it comes to Headwater, what you're getting is a small cap company yielding 8% as of right now, sustainable in the low 50s. They are growing a little, so I wouldn't be surprised if they dial back any growth capex, given we've got $60 WTI as we speak. So the dividend's a little more sustainable than what it would appear. This is a name that they always strive to have about 10 years of drilling inventory. It's a little more conventional than the average, but you're getting almost pure play to the Clearwater, which is just an exceptional resource. They and Tamarack and Spur have had amazing success with water flooding, which is exceedingly boring but exceedingly profitable. And so it's been lowering decline rates, lowering sustaining capital, making business models more and more sustainable. This, I will say, it's on the list in terms of candidates to add in our main fund. We own it in the income fund. My hesitation is, do I want to, if I get an incremental dollar, do I want to buy natural gas or oil? But on the merits, it's very inexpensive, good resource base, top decile economics, management team that is very well respected, and an 8% dividend yield that's very sustainable.
So Politics Society was also asking about whether you see some movement either from the U.S. Entities coming up to own some smaller Canadian entities or some aggregations.
We do, yeah. I gave a speech at the CAP conference last week, and that was one of the major themes, and that is U.S. shale is in its twilight. Companies, we believe, have profound and growing inventory challenges. U.S. shale will not grow this year at the current oil price. But more importantly, they're depleting their inventory, and the quality of that inventory is getting worse. And so when you think about around the world, where can one go to replace that inventory? You're not going to go to Venezuela. You can't go to Saudi Arabia. What's left? And it's Canada. And so it would be helpful to have a government that actually recognizes that everyone's living standards could be massively improved if we embrace that, instead of trying to attack a problem, be the only country on the planet trying to solve that problem. So we're optimistic that you're going to see an M&A wave in Canada over the next year to 2 years, dependent upon the outcome in the next couple of weeks.
Got it. Okay, let's go back to the phone lines. Brad's on the line from Toronto. Hi, Brad.
Hello. With the price of oil and gas stocks down materially over the last year, are you seeing evidence that some companies are taking advantage of those low prices to also materially buy back more stock than you would have envisioned before?
Yeah, so it was an opportunity about 2 weeks ago when share prices fell and the price of oil, i.e. free cash flow, did not. So there was a massive disconnect. We saw some companies like Athabasca, which is a big holding, they bought back 2% of their shares outstanding in the month of March. So annualize that. It's very aggressive. We have seen a lot of both share buybacks and insider buying in the past couple of weeks. From my meetings with companies, and I don't disagree with the priority of this, it is when the price of oil was collapsing, we've recovered a little, but we're still 60-ish. We're fine. It's not glorious. The priorities are protect your business, protect your balance sheet, protect your dividend, and then protect your share buybacks. And that's the order of prioritization. Balance sheets now are exceedingly strong. I put up a graph on Twitter, and we have to X out company names because of compliance reasons. People have been asking about that. But the sector average is 0.9 times debt to cash flow at 60. That's very, very strong. So in terms of protecting the business, protecting the balance sheets, that's check and check. Dividend sustainability, we estimate $51 to keep production flat and pay the dividends. That's on average. So you can check that box off. And now it's basically any residual free cash flow is going towards share buybacks on a monthly basis. We haven't seen any massive letdown in that. We are approaching blackout. So around earnings season, you will naturally see companies have to stop or at least slow down the pace. And then we'll reemerge from that in a couple of weeks' time.
Got it. Okay, let's go back to the phone lines. And Bill's on the line from Peterborough in Ontario. Hi, Bill.
Hello. Hi, Eric. Based on what you just said about insider buying back their shares and insiders buying in general, Trican Walls is hitting those checkbox. I know they're a small company, but would you be a buyer at these levels, or will you be adding at these levels? Thank you.
So this is a high beta service name. I've known Brad Flora for many, many years. He's a very honorable and respectable and a good operator. This company has been following the share buyback playbook for the past couple of years, and its stock had been a very good performer due to that. Obviously, a little bit of a check back now. You've got net cash, so they can survive anything. You know, free cash flow, I wouldn't be surprised to see a little bit of weakness in both oil. Gas has been strong leading up to LNG Canada. A lot of names like Petronas and others were front running the demand coming from that. I'm a little cautious in the service sector in general right now. With the admission, again, Trump, depending on what he decides to tweet, we had a day last week where services were up 20 or 25% on the day. So these are high beta names.
From something that he put out?
Correct. Yeah. This, what was it? I think it was the extension, the 90-day extension. That's what it was. And
yes.
names just
across the board.
Names ripped, right? So setting that aside, in normal course, we go ahead with penalizing China by 134% and worries about global GDP and demand and all that stuff. I just struggle to see how service names outperform. What's going to perform now is going to be oily names with an underlying dividend yield, which is supportive. Like once you get 9%, I kind of think that's a floor for pricing. Or we're long two special sit names where we're getting decades worth of inventory, we think, for free. Other than that, I think natural gas is the way to go. We don't own any services right now.
Got it. Okay, I want to get one more caller in before we have to go. Beth is on the line from Hamilton, Ontario. Hi, Beth.
Hi there. How are you?
Hi, Beth.
We're good.
First time caller, actually.
Oh, congratulations.
A little nervous here. Anyway, I wanted to ask about Occidental Petroleum.
Sure.
And why would Warren Buffett have bought so much of it? And that's my question.
Many of us,
thanks, Beth.
I share your bewilderment with that. Why did he not come to Canada? You get better valuations, you get better resource depth, you get management teams that are equally respected. It's a bit of a conundrum. I think the angle used to be when the ESG angle was a little stronger than it is today. They have a clean tech area where, because of tax credits from the U.S. government, I think you could have justified the investment thesis. We do think that they have some inventory challenges in certain areas. And so why would you pay a premium for Oxy when you can buy C&Q? You're getting decades and decades and decades of inventory, strong balance sheet, 6% yield. And maybe not a catalyst in a couple of weeks' time to unlock that or to reduce that political risk discount. I think there are better opportunities than Occidental right now. Got it.
Okay, we do have to leave it at phone calls. Beth, thanks for calling in. Call anytime. When we come back, we will take a look at our guests' forward picks. We're back in a minute. Time now to take a look at top picks with Eric Nuttall. His first pick, forward-looking, is Nuvista Energy. TSX NVA. Let's talk about Nuvista and why you like it.
We like Nuvista because it offers near-term leverage to a bullish outlook for natural gas and long-term exposure to a very bullish outlook on oil. It's roughly 60% gas, 40% condensate, so think of it as a very light oil consumed by the oil sands for blending purposes. Very, very deep resource base. What they're doing is they're growing production over the next 5 years by roughly 50%. While also buying back roughly 30 to 50% of their shares at $60 to $70 oil. And so it's kind of the combination best of both worlds. Once they reach their 120,000 barrel per day target, or BOE per day target, the plants that have been built and facilities will effectively be filled. And so it's our desire then, I think the second largest shareholder, is they will then flip to returning all of the residual free cash flow back to us. By our estimates, at $70 oil, that's again 5 years, we think that's being conservative. Doesn't feel like it today, but we think that's conservative. And $4 gas, we think they'll free cash flow about $1.40, $45. which is about a 13% yield. And they can pay that to us for well over 25 years because of the resource depth that they have. And so we get an exceedingly strong balance sheet. This is not the Nuvista of 2020. We'll be having a very different conversation today, even lower oil price. I've got a newish CEO. He was the CEO, Mike Lawford. I think he's a very, very honorable. He's been executing extremely well. The game plan is very clear. He's embraced our philosophy about the necessity for returns. And you have seen recent M&A where Ovintiv bought a similar-ish asset package off of off of Paramount.
Okay.
So Ovintiv bought, Paramount sold. And if you use the transaction multiples, it would imply about an $18 to $19 share price for Nuvista versus sub $12 today. And so maybe you wake up one day, maybe you don't. If not, the game plan is very clear. It's self-funded growth combined with meaningful share buybacks with a very tantalizing yield in a few years' time once they reach peak production.
Okay, so overall, you like it. It's a hold down the road.
Yeah, it'd be a 10.5% weight for us right now. We're going to sit on it. I'm actually hoping I don't wake up to a 30% premium because we see much greater upside down the road, and our clients typically are very, are giving us the ability to not worry about short-term wins. We see meaningful upside as a medium-term hold.
Got it. Okay, let's go back to your next pick, which is ARC Resources, ARX, on the TSX. And why do you like ARC?
So similar strategy. They sanctioned, they've fully brought on Atachi, which was a growth project for them. Superb economics. They have about 4 to 5 more of those buried in their asset portfolio. So this is a name, again, it's kind of like Nuvista. You get some liquids exposure through their condensate, but it's a gas play as well. We think that the outlook for Canadian natural gas is meaningfully improving as LNG Canada comes on, so long as domestic producers show the discipline being seen in the United States and not flooding the market in anticipation of better days ahead. What we see is about a $1.10 differential of AECO relative to NYMEX. We think NYMEX, we use 4, we see potential for $5 in 2026. So at $4 and $60 oil, they're trading about 5 times cash flow. At 70, be 4.5. So some leverage to that. Their U.S. peers would be trading anywhere from, I'm going to say, 6 to 9. So it is trading at a discount. I think once American investors realize there are very few investable names in the United States, and I would know because we own all of them, and then you look for other names, ARC really stands out to us as a very good value proposition. So it's a little sleepy. They're very conservative guys. In this environment, that is exactly what you want. You get a modest dividend of about 3%, but it's really the embedded resource value, which we think will be realized by somebody down the road. Okay. And in the meantime, they're paying that dividend, they're modestly growing, and they're buying back their shares.
Okay, I do want to just ask you, because we meant to touch on it before, whether you've seen the kind of fluctuations in natural gas when we look at oil and we see what's happening there. I'm just wondering how natural gas has been affected in this cycle.
Natural gas typically is even more volatile than oil, usually because most of the demand is from weather. And so, I've been probably the biggest bear for the past 5+ years, because anytime you get bullish, Mother Nature comes and kicks you in the behind. You either have a cold summer or a hot winter and your demand goes out the window, inventories get flushed, and the price craters. What we actually have had is a normal winter for the first in a couple of years, but it's really the incremental demand coming from liquefied natural gas. In Canada, more so in the United States, demand there is doubling. So you're reducing the dependence on weather somewhat. It's still, susceptible to the vagaries of weather. But in a world where, like, TC Energy says that North American demand is going to grow by 40 BCF per day, it's a massive number between now and 2035. Little of that is data centers. The vast majority of that is LNG. And so the economics make sense. We're lower supply costs relative to the global averages. Most countries, like in India and in China, want to decarbonize, get off of coal, use gas. It's much more clean
that's
burning,
where we see that growth.
Yeah. So we're bullish on gas for the first time in many, many years.
All right, let's get to your last pick then, which is Athabasca Oil, which I was asking you about at the break, because we're talking about whether or not to dip into oil at where it is now. Yeah, so I've said a few times for the incremental dollar, we prefer natural gas. There are exceptions to that. Why we like Athabasca is we're getting a very clean balance sheet, i.e. they have no debt. They've got roughly $134 million of net cash, very, very defendable. Their business model is to slowly grow as they build out Leismer, superb economics even at the current oil price. That's defendable down to 50.
And they've shown tremendous success at being, it's just a very clean story. I'm going to call it a pure play-ish oil sand name, modest growth, 50 years plus of stay flat inventory, and any residual dollars they're using to buy back their shares. In the month of March, they bought back 2% of their shares outstanding alone. And so this has been a underestimated management team. They've done a spectacular job. And so I'm getting exposure to better days ahead for oil, whenever that day will come, a bullish view on the discount for Canadian oil remaining heavy. We use $12.50, it's lower than that today. The resource depth of 50 plus years, a very defendable business model, a very defendable balance sheet with net cash, and their strong adherence to strongly buying back their shares as long as free cash flow allows. And so I'm still a believer in $70 plus down the road. At $70 over the next 5 years, they'll buy back 60% of their stock and still have at least 45 years of stay flat inventory, i.e. dividends down the road. So we see very deep value.
That is a story for Athabasca Oil. We've got to leave it there. Eric, thanks for coming in. Appreciate it.
Thank
we'll
you.
see you again soon. Let's take a quick look at the markets as we go. Thanks for joining us here on Market Call.